Hello and welcome to The Pitch. I'm Sarah Allen and today I'm joined by Stephen Wood. Stephen is the Principal and Portfolio Manager for Eiger Capital, and today we're going to be talking about small caps and the opportunities in this space. Stephen, welcome.
Thanks, Sarah.
So to begin with, where are we in the small cap cycle and what are the key headwinds and tailwinds you're seeing?
Well, Sarah, if you'd asked me this just on a month ago, as we were rolling, sort of into the back of reporting season, which is obviously, for small caps, mostly the back half of February, I would have probably said to you, look, things are starting to look pretty fully valued. If you look at the long-term averages for PE ratios in the small cap market, we're approaching sort of 21 up to 22 times, forward PEs, and that's starting to look like pretty full value. And it wasn't just small caps, it was kind of mid caps as well. The ASX 200 was a little bit lower, and both the mids and smalls were at a decent sort of 10 to 15% premium, not only to the long-term averages, but to the ASX 200 as well. So a month ago, starting to look, a little bit fully valued. However, reporting season was quite a bit stronger in many sectors than many of us were expecting, and you'd call out retail, was quite a big one. And I think in the post-mortem from reporting season, a lot of people are now looking back going, Melbourne Cup rate rise, probably not great for retailers rolling into Christmas. What on earth has happened? And I think looking back now, we're probably going immigration. A lot of people have turned up. They've got to fit a house out. They've got to fit a flat out. The students are all back. The economy is actually stronger than we probably had expected. Earnings revisions are up, and consequently, those target sort of forward PE ratios that we were talking about, while the stocks haven't dropped, the earnings have actually been pretty strong. We've seen, across the board 10 and 15% upward revisions to earnings, and consequently we've now got those forward PE ratios right back around the sort of 16 mark, which is actually not too bad. So I would have said to you a month ago before reporting season, looking a little bit fully valued. Earnings are going well, and if we do get rate cuts in the US later on this year, then that's probably supportive for valuations as well.
Okay, so off the back of that, are we now finally seeing the market for small caps?
Reasonably positive. I mean, we've got a strong economy. I don't think we're going to get necessarily rate rises in Australia, nor do we think we're going to get rate cuts, but the economy is going very well. Consequently, earnings are looking good, and markets responding accordingly.
Where are you seeing the best opportunities?
We've got, several ideas. Probably at the moment, some of those sectors like retail, some of the REITs have run pretty hard. So probably stepping through that at the moment, a few places that have been left behind a little bit are things like energy, excluding uranium, which has been strong. And one idea that we've got in that space is a company called Karoon Energy. They made a major acquisition late last year. It's sort of diluted their share base, for want of a better term. There's been some indigestion around the capital raise. The share price has been sort of stuck at around about $1.90, a little bit under $2. Pre the raising, pre the acquisition, it was sort of more like $2.35. We've seen the oil price a little bit soggy, but the oil price has come back now. We've got Brent, sort of now circa sort of $84, $85, and we think Karoon with the new acquisition can actually have a pretty solid year ahead of, very, very strong cash flows. So that's one idea that, is a stock that, particularly if the global economy, we start to get rate cuts, could actually go pretty well. Another one that's very non-economic dependent that we like is Telix Pharma. It's a stock that really exploded, in the last 15 to 18 months, where its first product hit commercialisation. It's generated some enormous revenues on the back of it. And the fabulous thing that it's got going is that in the next year, it's got two adjacent products coming to back up the one that they've already released, which has generated some very strong revenue. They've got an equivalent product that I won't go into all the details, it's pretty technical, but it's to do with kidneys and brain cancer. The first product was, similarly related, but they could generate very similar revenues. They look like they're going to get approved in the next 6 months. So, if that comes through, then, there's another stock that has not got caught up in the, oh my goodness, the economy's stronger than we expected, that could actually do quite well as well.
So onto the stocks that have been caught up in that in the economy. What are some sectors that you're avoiding? Have you sold any positions as a result?
Well, as a general rule, what we avoid are stocks that have low return on invested capital. So they tend to have lots of capital, low margins, and often limited growth. And for us, the best group of stocks that encapsulate that as REITs. They own a lot of land, they're very capital intensive, and they have limited growth. Now, that sector's actually done quite well in the last 3 months. So there's a sector we would probably avoid. As a general rule, the retailers have been epically strong, in that last 3 to 4 months. And frankly, we didn't expect them to be that strong, but they have been. But with some of the earnings valuations that we've now got in that space, with a few very selected exceptions, that's probably an area where we kind of think, well, a lot of that juice has probably been drunk, so we'd probably let that go as well. So I think generally the REITs, which have done well but are capital heavy, the retailers have just been exceptionally strong. There's probably a couple of areas that we kind of go, well, let's go looking for something else that hasn't done so well or is not cyclically exposed. The best example we've got at the moment is Telix.
So you've mentioned Telix, you also mentioned Karoon Energy. Are there any other top stock picks you've got for this year? Well,
another stock that has certainly got bipolar views out there in the small cap space is Johns Lyng. Johns Lyng came onto the market, well, didn't come onto the market, but got people's attention with a bit of a hiss and a roar in sort of 2018-19. They are in the construction space, but they're more in and around restoration work for insurance companies or for body corporates. For example, when something goes wrong in your apartment block, that's more their style than actually, building your house or building an apartment block or helping out with an airport. So they caught people's attention back then because we had massive floods in northern New South Wales, we had massive floods in Victoria, and we just had bushfires. So they had this enormous body of work, which let's just call it catastrophe work. So the market suddenly went, oh my goodness, look at all this work they've got. The stock went from not very much to $9. Obviously what happens over time is people start going, well, the thing about this catastrophe work is a little bit of a one-off, unless we think it's going to happen at that rate over and over and over and over and over, which it does, but not to that degree. So the market's kind of re-evaluated that and started to pull it all back. But over that last couple of years, while that's been happening and the stock price has gone from $9 to sort of $6, they've been building up their business as usual revenue. Because there is a lot of insurance work that's not just, oh my God, Lismore's been flooded, 3 times this year. There's just a lot of ongoing maintenance, breakages, more minor weather damage, which is happening more frequently. So that business is building up and up and up and up. And not only that, but they've now expanded in the US. And very recently, they got on a panel with Allstate, which I think is either the second or third biggest insurer in the entire United States. So while the market's kind of gone, catastrophe, yeah, not so good, what's left, what is this? The underlying business as usual revenue is growing very nicely, thank you very much, and will top $1 billion this year. There's a great opportunity they've got in the US, and the market's kind of left this one a little bit behind. So if we were to pick a stock that could reignite some of the enthusiasm that the market could have for it, it would be this one. It's been left behind. They've got a couple of things they could deliver on, particularly expanding that US business, and we think it looks like really good value, assuming they can pull that off.
A bit of a hidden gem.
Yes, for want of a better term, why not?
Thank you so much for sharing your insights today. If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.